Chris, it's James again. We're back. It's another episode of the Equity Accelerator podcast.
Yes.
My name is James Adair. I'm a mortgage loan originator based in the Portland, Oregon marketplace. I'm licensed in the state of Oregon, licensed in the state of Washington, and I work for a company called Sierra Pacific Mortgage, a wonderful organization based out of Folsom, California. And we like to talk about ways to build your real estate business, manage your mortgage business, to be strategic about making mortgage decisions, personal finance tools and tips, parenting tools and tips, anything that could bring acceleration to your actual equity, spiritual equity, financial equity, whatever. We're about accelerating it. We don't want to go slow. We want to go fast.
That's right. Acceleration.
So that's what this podcast is about. And today, you know, every now and then we talk about real big ideas and stuff, but today we're talking about something a little bit boring, but super duper important. And I want to tell you something about mortgage insurance, Chris Angel.
Yes.
Oh boy. Don't turn it off yet. This is going to be the most exciting podcast about mortgage insurance you've ever heard. I
do think that what I've come to trust you provide is perspective that otherwise we don't have or aren't familiar with. Like, first of all, I think most people with mortgage insurance forgot they had it. Like they got it and then they just make their monthly payment for their mortgage and they forgot they had it. And I think if you're a real estate agent listening to this, like these are the conversations you want to know about so that you have an edge as an agent over other agents, because when you know the details, people treat you like you're an authority.
Yeah. So this is a way so think of this as a 15-minute primer on how to just improve your expertise around a very important topic. Now, most people, when I talk to borrowers and people looking to create, a financing plan to buy real estate, they're like, I hate mortgage insurance, or I want to refinance to get rid of my mortgage insurance because I hate it. And it kind of hurts my feelings a little bit because people don't realize how important mortgage insurance is to the global economy. If it were not for mortgage insurance, I mean, housing values would be in Portland right now. The average home price is like $425,000, or the median home price is something like that. And if it weren't for mortgage insurance, I mean, I have to believe the median home price would be like $199,000. It would be so much lower. Mortgage insurance allows people to borrow more. And people don't understand what mortgage insurance does. It's insurance that the lender requires the borrower to take on, and it doesn't insure the home. What it does is insure the bank in the case of the loan going into default. So if you wanted to buy a $400,000 house and you wanted to put 5% down, 20 grand, and borrow the remainder. So do the math quick.
I can't even.
$380,000.
Nicely
okay,
done.
$380,000 borrowed against a $400,000 house. So you're putting less than 20% down. Whenever you have less than 20% down, the bank requires you carry a mortgage insurance policy, and that only benefits the bank if you fall on hard times and stop making the payment. Then the loan goes into default. At that time, if the loan's insured, the lender can file a claim, pay themselves a portion of that loan back without liquidating.
The lender being the institution, not the loan officer.
Correct. It's the bank. Whoever's whoever's servicing that loan at that time is responsible for managing that foreclosure process and liquidating the real estate asset, paying as much of themselves back as possible. And the mortgage insurance takes a lot of risk off of the lender. It's as if you put 20% down if you're carrying the mortgage insurance. Basically, it's an insurance company saying, you don't have to put 20% down because you fit our credit profile of someone who will make their payment. This piece of real estate will go up in value enough, and you're responsible, and you have enough equity in here to stay bound to the property. People don't realize how much risk is alleviated by having just a small down payment. If you have $15,000 in a property of your own money, and you default, you're walking away from $15,000 of your money plus whatever, principal you've paid down. So if you have zero down and you fall on hard times, you can just be like, well,
Right.
I
No
can't
skin in the
make this
game.
payment, and
Yeah.
I'll
I
just
didn't lose anything.
somewhere else.
Oh, well, right.
You're not walking away from anything. So having a down payment just binds you to the property. And that's another, occupancy is a huge driver of risk as well. So mortgage insurance is priced based on how much you put down. The minimum down payment is 3%. So you carry a fatter mortgage insurance policy on a primary residence.
Got it.
There are break points in cost. So 3% is your basic minimum down payment for a conventional loan. 5% down, the cost of mortgage insurance drops dramatically. 10% down, it gets cut in half again. 15% down, kind of gets cut in half again. And then at 20% down, it's just not required. It's gone, not required. Yeah. So it's only for loans that you put less than 20% down, you trigger mortgage insurance. Sometimes they call it PMI, stands for private mortgage insurance. And there's PMI, and then there's FHA and VA, government mortgage insurance, USDA, right? So there's a couple of different operators in that mortgage insurance space. Some are operated by the federal government, which is the FHA, the VA, and the USDA loans. Those are government insured loans. Yeah. And then the conventional loans have private mortgage insurance,
but the principle
is really only managed by a handful of companies.
Yeah. But the tool, basically the tool of it is the same, regardless of who has the tool or who the tool is served by. It is trying to make people have the opportunity to afford more than they normally could afford. Without the mortgage insurance, banks wouldn't want to loan you the money because they have too much exposure. So with the mortgage insurance, it alleviates that exposure. Right. Yeah, the biggest barrier to homeownership isn't the ability to make the payment. It's the ability to save up enough to bring a down payment. So mortgage insurance really solves that problem. Another question I get from people is, how can I get rid of mortgage insurance once I have it, right? Yep. And that's a really there's not a lot of good information out there, right? Which is really why I wanted to talk about it. I just got an email today from my rep at Radian Mortgage Insurance. Shout out to Radian. Basically it's about canceling mortgage insurance. And I was like, this would be a great topic to talk to Chris about, because this is something that's always on people's minds at different times. And a lot of people think, as soon as I get 20% equity, mortgage insurance goes away. And that's not entirely true. So if you get a loan with mortgage insurance, you have to have it on that loan for at least 24 payments, which is roughly 2 years. It's actually a little longer than 2 years, because sometimes your first payment isn't for a month or two after you close. Right. So you need to have 24 payments, and they all have to be on time. And once that's happened, then you can call the lender, or you can call the servicing, because we write the loan. A lot of times it gets sold. And Sierra Pacific Mortgage will maintain the servicing. And sometimes Sierra Pacific Mortgage will sell the servicing to another bank. It'll go to Wells Fargo or Chase or whatever, one of the big servicing entities. And whoever is holding the note at the time you feel like mortgage insurance should come down, that's your first call. And you just call them and say, what's the process for eliminating the mortgage insurance? And basically you kind of negotiate with them you have to agree on what the value of your home is. Right. So if you started with 3% down and you fast forward 2 years, probably don't have 20% equity. I don't care what market you're in, right? Yeah. Right. It takes longer for your loan to pay down and for the market to put you in a different position. So that's what you'd have to do, is to see, well, how much do you think my house is worth? You can maybe do a big principal reduction payment at that time to get you to 80% of what they think it's worth. Yeah. If that's worth it, right? Right. So that's kind of the process for getting rid of mortgage insurance. It's kind of, and then if you get an FHA loan, it's part of the loan forever. It never goes away. The only way to get rid of FHA mortgage insurance is to just close the loan and refinance it with a new loan that does not require mortgage insurance. Let me ask you this question. Curious minds want to know. I would imagine many homeowners who have had their mortgage for 5-10 years, especially in Portland where appreciation's been crazy.
Right.
Still have that loan. Maybe they have that loan even because they're like, oh, well, the rate was really good. At the time they got it, the rates were really good.
Exactly.
But they still have Mortgage insurance, like, mortgage insurance payment is how much extra roughly, depending on it depends on purchase price, but I mean, you're talking hundreds of dollars.
Yeah, it
a
could be
month.
anywhere. It's a function of the borrower's credit profile and down payment
Right.
applied to their loan amount. So the more you borrow, the more expensive the mortgage insurance is.
Right.
And it could be anywhere from, $90 a month on the lower end.
Sure.
I've seen it even less than that. If you have 15% down and like a $200,000 loan amount on a smaller type deal, I mean, the mortgage insurance there might be $40 a month or $50. It might be pretty low if your credit's good.
Right.
But it's not uncommon for it to be $150 to $250, 200 on a large FHA might have $300 a month of mortgage insurance. So it can be significant. And it is a great reason to consider a refinance, even if the rate goes up, because sometimes it's not just the rate, it's the total cost of borrowing. So it's the rate plus the EMI.
This is totally in your wheelhouse, man. This is like, I mean, this is the whole conversation, right? Like,
yeah, exactly. It's like, I have a 3.625 interest rate. Yeah, it's an FHA plus it has $290 of mortgage insurance.
Right.
What if we refied you into, 4.25 and you save $200 a month,
Right.
Who knows?
Yeah.
So all that is it's not just about the rate. It's about the, totality of everything.
Right.
So mortgage insurance is a huge part of the mortgage conversation. So you can pay for it monthly. I also wanted to add this. You can pay for it as part of your monthly payment, or you could do what's called single premium mortgage insurance. Not a lot of people know about this. You can actually just buy the insurance for the whole life of the loan in a lump sum. And man, 3 or 4 years ago, that's how we always did it. It's called lender paid mortgage insurance. It didn't cost that much more, maybe a quarter higher in rate. And you just know mortgage insurance, and you can have a little bit of and when rates were low. So instead of getting 3.75 with 5% down, you could do 4% and you'd have no mortgage insurance.
Wow.
So a lot of times that trade-off resulted in an immediate lower payment and a better tax benefit, because you can always deduct the interest on your primary residence, but not always deduct the mortgage insurance. So when you kind of structure it that way, it creates a number of benefits that way.
And to drive the point home, like, we've talked about, sometimes you could go online and try to get a mortgage from an online lender with really good rate, et cetera. But when you have somebody that doesn't know, like, you don't know to ask these questions of the lender. This is why having somebody like James, who does active equity management, is going to come in and be like, well, what's important to you? Like, let's figure out the way to use this tool to create the most desired outcome.
Right. How do we kind of use the nuances of the different ways to set these loan plans up to give you what makes the most sense, right? And not everyone has done as deep of a dive into this as we have here. That's for sure.
So good.
I think it's just an important topic. I wanted to have a podcast about it so I can lean on it in the future as people have questions around how do I get rid of my mortgage insurance. It's really just about 24 months payments minimum, verify that there's enough equity there. A lot of people say, I need 78% loan to value, 80%. You really just need 20% equity, 24 months. And so the lender, it's up to the lender, right? They could say, look, we need you to keep mortgage insurance on this house for another year. Call me back in 6 months, 12 months, and we'll reassess. So there's no hard and fast way or guaranteed way to get rid of mortgage insurance. But there is some federal law, the Homeowners Protection Act. Ken Perry, if you're listening, look at me go. Ken Perry's the compliance guy he runs something called the Knowledge Coop. He's this continuing education for the mortgage industry. So the Homeowners Protection Act makes it so mortgage insurance, it's illegal for mortgage insurance to be on a loan when you definitely have enough equity, right? So at some point, the mortgage insurance will come off automatically without the phone call, but it takes a really long time. And it's because it doesn't go off of the market value of the house. If you bought a house for $200,000 with 3% down, the mortgage insurance will come off automatically when you've paid the loan down to, $160,000. So that would take 9 or 10 years probably, right? So eventually it will come off automatically. But if you want to accelerate that equity, my friend,
accelerate it.
I'm just pregnant pause. If you want to accelerate your equity and get rid of the mortgage insurance before it comes off automatically, there is a process to go through, and it's a little bit of case by case. The only way to guarantee the removal of mortgage insurance is with a new loan, refinanced, bring enough cash into the table to make sure that the remaining loan is, has 20% equity.
Yeah. And if you don't, and if your house is appreciated enough, you don't need cash necessarily, right? If there's enough equity in the home,
right? If you've been in the house for at least a year, I think after 6 months, we can use a new appraised value. So if you get like some kind of sweet deal on a house, and fix it up, put a bunch of money in it, and reassess the value, and it goes way up in value, and it's only been 8 months, we can use the new appraised value at that time. And just refinance, and it doesn't take any money out of pocket.
Or if you've lived there 5 years, 6 years, 7 years.
Exactly. So sometimes it just happens over time.
It all starts with a conversation. One call does it all, right? One call. Come on. One call to James does it all.
What is this, FM radio drive time?
Yes, exactly. Right. Yeah. Well, I think that is where it starts. I mean, if you're interested in what James was just breaking down for you, then ultimately you got to figure out what your situation is. And that does start with a call. So
yeah, give me a call or email me. It's probably the best way. I always share that here on the podcast. It's easy to remember. My website is pdxhomeloan.com. There's no S on the end. It's just singular, pdxhomeloan.com. And my name, James at pdxhomeloan.com. And we'll be in touch. We love hearing from you. Thank you for listening to the pod. And Chris, why don't you take us home?
Yeah, man. Well, thank you. Thanks for a great episode. Until next time, James, as always, take care and see ya.